We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Justin Huhn, founder and publisher of the Uranium Insider newsletter. How are you today, Justin?
Doing really well, Tom. How about yourself?
Excellent. Thanks for joining me. And of course, we're speaking right at an exciting time. Obviously, there's not much to talk about in the precious metal space here and there after a really kind of dull summer, but it seems like uranium has had almost the exact opposite. There's some exciting developments to talk about in that space. One being the spot price last week hit a 12-year high. So why don't we talk a bit about the significance of that price and the move to get there, rising 10% in the last month here.
It's been a pretty historical move, Tom, especially in terms of seasons. Typically, the summer is the slow season. Usually have equities kind of just bored in the summer season. The spot price usually isn't moving a lot. There's not a lot of term market activity, which that was actually the case this year. Term market activity has significantly improved in the past few weeks, but June, July, even through August, term market activity was relatively low, maybe up until the last week or so. Spot price usually does nothing. This year, it was actually slowly climbing on very small volumes. That was a big tell for us last month before we've had this big move. This is something that we signaled to our membership over and over throughout the summer, which is something is different here, you guys. Really, we're not just kind of trying to talk ourselves through a boring period in the market, but this is really different. We don't usually see price moves in August to the upside, especially in very small volumes. That was the other big tell. And that has just accelerated substantially over the past few weeks. Very, very small volumes purchased in the spot market are causing big price moves. So something's definitely different here in the spot market. The term market is heating up. That, of course, is difficult for most investors to see unless you're having reports coming from the nuclear fuel analysts like UXC or Trade Tech or giving details on term market activity. But let's just say that it's ramped up significantly. We expect a lot more pounds in term contracts to be inked before the end of the year. And it's these types of price moves, they really don't happen very often. And when they happen, it absolutely should get your attention that something is happening here. So we've never seen a $10 move in the spot price over a period of 30 days, with an exception of the very peak of the previous bull market. And that happened, the last 3-4 months of the blow off top in 2007, where we saw the price go from 90 to like 105. This is like 30-day periods, and then 105 to 120, and then 120 to 134. It was like the last 3 or 4 months, it went from like $90 to $134. Huge moves, but that really was a blow off top driven almost entirely by financial players. Yes, a few utilities signed contracts around $100 a pound. That did happen back in 2007. They never lived it down. But the blow off top happened from hedge funds buying primarily. So this time really does feel different. I know those are the most dangerous words in investing, but this move has happened almost entirely without financial speculators, without secondary demand. Sprott bought 100,000 pounds on Friday, but they haven't bought a single pound since April and haven't raised money since February until about 10 days ago. So risk has come back on into the capital markets a bit in this space, which has been encouraging. Volumes have improved, which has been encouraging. But the move in the physical market is not coming from Sprott. So those previous 2 spikes that we saw since the beginning of this bull market was September, October, into early November 2021, and then March, April 2022. And those big spikes were huge volumes in the spot market. And that was almost entirely driven by Sprott, if not literally buying from Sprott. It was traders trading around the activities of Sprott. So big volumes in the spot price. Now what we've seen is this slow recovery after the dip. So March, April, it jumped up to $65 a pound, fell pretty quickly back into the high 40s. Mm-hmm. Then from there, it had some slight oscillation, but for the most part, it's been a slow sort of grind upwards in the spot price on average volume in the spot market. Now we're seeing big moves on very, very little volume. And the question that I keep asking myself and asking my team and kind of putting out there is like, where's the relief going to come from? Where is the spot market liquidity going to come from? And people that have more hours into this thesis than I do don't have a good answer for that. So it's a very interesting time. It's very interesting. I think, honestly, I think things could actually get pretty wild here just because I don't know where this supply is going to come from. And the uncovered needs are pretty great from utilities, let alone spot market volumes increasing at all are going to cause big moves in the spot price.
Yeah, it's pretty crazy when you think about it from that respect, that there is all of a sudden there's this change where, as you say, there's this small volume driving the price in this way. And that kind of plays into your thinking around, not being anxious here about this being kind of a blow off top. Is that right?
For the commodity, yes. It's easy to look at the equities here and say, oh, these are obviously overbought on the daily charts. They're pretty overbought on the weekly charts. If you zoom out and look at monthly, we're good to go. But, short-term overbought conditions in equities in a raging bull market. I'm not saying we're necessarily there, but if you look at the commodity price action, it's very, very encouraging. So if you actually chart, let's say URA in the first leg of the bull market, so December 2020, within a month, we had very overbought conditions. We had a tiny pullback, and then it doubled again, not doubled, but then it went up another 30, 40% on the next leg of that first leg. So these overbought conditions could be relieved in a very, very short-term dip. And so far, the dips since this run started have been shallow. That's the equities. Then we look at the actual spot price. Okay, so to give you some detail, we're recording this on Monday, the 25th. Last week on Thursday, a single 100,000 pound request for proposal, RFP, in the spot market moved the price $2 a pound. The following day, Sprott was in there buying 100,000 pounds, which, just so your audience understands, historically 100,000 pounds is not a lot of uranium. If you go back to the price spikes of the previous sessions when Sprott was really coming to the market pretty hard, they were buying 1 million pounds in a day, 1.5 million pounds in a day. They were buying 2-3 million pounds sometimes in a week or two. Okay, so 100,000 pounds, historically speaking, the spot market is peanuts. It's not a lot of volume. So 100,000 pounds on Thursday moved the price $2. Another 100,000 pounds on Friday moved it up another $1.50. So we had a $3 to $4 move on 200,000 pounds in the spot market. That is historical. Okay, so we're not looking at, let's say, the jump that it made in 30 days, which is very, very large. You have to look at why it moved and what moved it. So if you said, oh, risk is on into SPUT and they bought 5 million pounds and the price went up $10, then it's like, oh, well, SPUT better keep buying if we're going to keep this trend going. That's not the case this time. They were not in there. And it wasn't volume driven. It was lack of supply driven. Mm-hmm. That's the big difference here. So the fact that supply is insufficient to satisfy very, very low volume demand, that's honestly, it's a little bit concerning, to be honest. I mean, from a speculator's point of view, it's great. I'm looking at the equities. They're on fire here. They, I think, have a long ways to go in this run. Does that mean I want to FOMO in when RSI is at 85? No, I don't. But will they be higher if I close my eyes for a year? Probably. Mm-hmm. But we're here looking at a really thin market, and we're just now going into what is typically the strong season. We're just now seeing utilities come in with pretty aggressive RFPs in terms of term market contract requests and putting tenders into the market. Multi-million pound tenders for the mid-2025s into 2030s. And as far as we can tell, there's not a lot of supply to satisfy those tenders.
Mm-hmm. Yeah, I think it's a really interesting, point in time here to consider, again, how much these small quantities have moved the market. And I think that really shows how tight that supply is, right?
Absolutely. To give you and your audience a little bit more color on kind of the dire situation for supply here. So the primary producers are essentially sold out of uranium for the most part, with very little supply availability for the next 4 years. You go out to 5 years, there's a little tiny bit, but pretty much through 2028, you've got Cameco, Kazatomprom, and to some extent Orano. Essentially, they don't have anything to sell into the market for that time period. That is historical. The reasoning for that, and I'll be quick about it because I've gone into length about this in my most recent uranium market minute, but basically the reasons for that is that utilities have flexed up legacy contracts. So contracts they signed in the past, they've come into the market and basically said to the producers that they've signed those contracts with, we'd like to receive more material as our contract allows. This was a buyer's market element of these contracts where the seller would offer flex provisions as to sort of juice up the offer, right? So they signed a contract with Cameco for delivery 2022 to 2025, whatever it might be. And the utility could flex up or down that contract. So in a bear market, utilities flexed down that partially left more supply to come into the spot market, which added to that oversupply of the previous decade. Now the reverse is true. Utilities are flexing up those contracts, requesting for more material from those contracts. And basically what that is doing is it's pulling demand forward. Mm-hmm. And material that would have otherwise been available to deliver out into the future in new contracts isn't there. So all the utilities that are having material delivered last year, now, next year, they're all flexing up because the contract price they signed was at least partially fixed price at way lower prices of the market here. So you're going to flex up all day long. If you've got a contract with a fixed price of $35 and the spot market is now $70 a pound, all day long you're going to flex up. That's really tightened up the midterm. The second thing is that the carry trade unwind over the previous couple of backwardated market moments when Sprott was buying like crazy shook a lot of pounds out of carry traders' hands. They were holding pounds to deliver into future contracts. They sold them to Sprott. They secured midterm contracts to cover that short. That also dried up the midterm because some of those midterm contracts were with some of these producers that are now out of uranium to sell. So what does the demand picture look like from here out the next 5 years? Now, we're not talking about SMRs, okay? We're not going to price that in yet, even though there's already an RFP in the market for the first SMR build. Yeah, it's already happening, okay? We're not going to talk about SMRs. We're not going to speculate on capital flows and secondary demand, even though Sprott's trading close to NAV and at a premium, and they've raised $50 million in the last week, even though Yellow Cake is at a premium to NAV, and they have yet to exercise their $100 million option with Kazatomprom this year. Even though Zuri is there, I think they're there in relatively small volume, but they have bought a little bit. I think they've been a buyer on the margin and it has affected the market despite the fact that they're utterly quiet. Nobody knows what the hell is going on over there. Despite the fact that ANU Energy is going to launch next year in Kazakhstan with potentially up to $500 million in interested capital to buy uranium from Kazatomprom and store it in a warehouse. Or this latest fund, PFYN, launching out of Singapore with the support of Askar Badarbayev, former COO, I believe, of Kazatomprom, based out of Singapore, potentially hundreds of millions in capital interest for that fund. Okay, forget about secondary demand from the financials. Even though it's there and it could get stupid at any moment, we're not going to think of that. We're not going to price in SMR demand, and we'll be relatively conservative with all other demand. So assuming that reactors are set to shut down in the next 5 years on schedule will, even though they won't. 200 million pounds of uncovered demand for utilities in the next 5 years. 200 million pounds. Where are they going to get that? I don't know where they're going to get that, okay? We have to think about they're going to be coming after the development projects, and the price is going to have to be far higher in order for those development projects to come online. So they're going to be praying that DASA gets developed in Niger. They're going to be praying that the US ISR projects can actually do what they're trying to do. Boss's honeymoon in Australia. There's a development project in Brazil that uranium is a byproduct. That is first production, hopefully in 2026. I mean, really, it's fingers crossed across the sector for Kazatomprom to increase, for Uzbeks to increase, and for that to fulfill that demand. Well, guess what? No, there's no switch that can be flipped that's going to satisfy 200 million pounds of demand in the next 5 years. That's just the uncovered utilities. So We're looking at a situation where some utilities very likely are not going to get the uranium they need. Now, the only entity that has uranium sufficient to satisfy any demand really at this point are the Chinese, and the Chinese inventories, not Chinese production, Chinese inventories. Chinese main production is coming from Namibia, coming from Rossing and Husab. That's their main production. Now they're sitting on probably 400 million pounds of uranium equivalent in inventories across the fuel cycle. Sounds like a lot. It is a lot, but let's put their build out program in perspective. They currently have about 55 gigawatts of nuclear. What they're shooting for is 150 gigawatts of nuclear by 2030. That's another, 95 reactors in the next 5.5 years, 6 years. So that sort of demand, and you say, okay, well, Justin, that's just wishful thinking, right? That's how are they actually doing it? Is the rubber meeting the road in terms of these build out plans? Well, this year so far, 6 construction starts for nuclear power plants this year. Within the next 6 months, another 8 construction starts are expected in China alone.
I was going to say that's just in China, right?
It's just in China. So let's do some back of the napkin math. 150 gigawatts in 2030. So 150 gigawatts is, let's see, 1 gigawatt is about 450,000 pounds of uranium demand. So 150, what is that? 70, let's say 70 million pounds per year, but that's at a relatively low tails assay. And we already know that enrichment tails are on the rise. So conservatively 70, probably pushing 80 million pounds of uranium demand per year just for China in 2030. So their inventories are 6 years, 5 years of demand? You think they're going to be pleased with letting that material go, especially in an environment where there isn't sufficient supply to restock that inventory, at least not in the near term? Mm-hmm. So first of all, there's no evidence that the Chinese are selling into the market. In fact, the opposite is true. What is the evidence showing? The Chinese have gone from marginal spot market sellers to marginal spot market buyers during calendar year 2023. That's the evidence. I don't think that they're going to be selling material that they can't easily cover off. So my personal assumption is not only will they not end up being that liquidity in the spot market, but B, they're probably likely to get more aggressive with acquisitions going forward.
Yeah, I was thinking from an incentive perspective, if they don't have the pounds to cover what they're going to need in the future, that would be just silly for them to come into the market to sell it, let's say prematurely when they are going to need it.
Yeah, exactly. Exactly. Yeah. So if they can acquire some large projects in Africa and get those things developed in the next 3 to 5 years, then maybe they'll be sellers on the margin, 3 to 5 years from now when they have line of sight on supply that can replace those pounds. But, historically speaking, they have not been, the temporary liquidity into the uranium market. We know, of course, there's history of China having large influence on commodities markets, right? That's no surprise. But we have to look at the evidence and we have to look at their plans. And their plans essentially are to be a nuclear powerhouse, an absolute powerhouse. So, it remains to be seen where that supply is going to come from. Will some pounds shake out of any unknown and unforeseen sources in the next few years if we get, north of $100 a pound? It's certainly possible. Mm-hmm. That's always been kind of the big bearish thesis is, well, what happens when we get to X price? Aren't, this entity or that entity going to start selling material in the market? It's like, well, sure, you can speculate on that. Thus far, the move from the bottom in 2016, $18 a pound to where we are now at $70 a pound. We've seen the opposite. As prices go higher, inventory is held on more tightly. The market is thinning out, not getting more liquid due to the rising in price. And that's exactly what, the first, the Mike Alkins of the world were predicting back 2017, 2018, when they're looking at this market, because that was one of the big questions. Will we get to this price? Are we going to see pounds shake out from the Japanese still sitting on inventory they paid high prices for on the books? The Chinese going to start selling, et cetera, et cetera, et cetera. Because Atom Prom is going to ramp. It's like, well, maybe, but usually in these markets, when the price goes up, people hang on to their uranium. I mean, why would you be selling the market here at 70 if next week you think it might be 75? I mean, people, they just hang on to material, and it's
you're actually and or you're actually going to need that material to actually use and create energy.
Yeah, it's one thing to be a speculative trader of this material, and it's another thing to actually have it as a strategic state asset for the production of electricity in your country. And typically, historically speaking, the Chinese have not really been all that sensitive to price when it comes to acquisitions or paying up for uranium. Will this time it be different? That remains to be seen. But so far, the evidence is showing that they're not coming in there giving any temporary liquidity to the spot market. They've been buyers this year and not sellers. So,
isn't that typically true though, Justin? Of the uranium, let's say, sector in general being somewhat insensitive to price simply because it is such a low percentage cost of actually building out a plant.
It is true. It is true. There's some nuance there, of course, depending on jurisdiction of where a nuclear power plant is being operated. Mm-hmm. Certain jurisdictions might have a nuclear power plant operator might have a more difficult time paying up across the fuel cycle and then competing in electricity prices with competitive, subsidized solar or cheap natural gas, if that's the case sometimes. And it was the case, I suppose, in the previous decade in the United States. But for the most part, uranium itself, if you kind of separate it out from the rest of the fuel cycle, of course, uranium typically doesn't move up in a bubble. The rest of the fuel cycle has already gone way up in price. We're at all-time highs for conversion, near all-time highs for UF6. Enrichment is very high. So uranium now starting to move is kind of just finally the wag has moved all the way to the tail from that excited dog. So everything else in the fuel cycle already moved up last year. We were obviously saying eventually that'll come to uranium. Now we're at uranium, and uranium's having its turn. So yes, uranium itself, separated from the rest of the fuel cycle, is usually only about 3 to 5% of the overall operating budget for a nuclear power plant. So if you have this multi-billion-dollar asset and your job is to keep it up and running, you'll buy it at $30, you'll buy it at $60, you'll buy it at $100. If you have to keep your plant operating, you're going to pay what the market asks. Mm-hmm. Will we get to a point where in certain places $150 a pound is too much to pay, and the nuclear power plant will just say, hey, we need some help, we need some subsidizing from the state or from the feds, or we're going to have to shut down, or have to raise our prices substantially? That's possibly the case, but we're not there yet. And that wasn't the case in the previous run. We didn't have power plants, coming offline because the price went to $134, and inflation adjusted, that's $200 a pound here. So I think we have a long ways to run. And generally speaking, yes, that is true, Tom.
Mm-hmm. So Justin, how do you think this changes the behavior of, let's say, a country like China that sees, their planning throughout a longer fuel cycle? China's typically known to really be very proactive in their planning. So how does that change their behavior to go out and start to, buy up projects, let's say, around the world to be able to replace those pounds in the ground that they are going to need?
Well, honestly, I think that the acquisitions is really where China will start to step up. And the reasoning for that is they can build out capacity for the fuel cycle services, right? Which they are. They can build out conversion. They can build out enrichment. They have always expressed the intention of, when it comes to uranium, of having a 1/3, 1/3, 1/3 policy. So a third of their uranium needs would come from domestic production. A third would come from contracts, signing contracts with producers, international producers. And a third would come from actual project acquisition and development. The first third is an absolute joke. They're never going to get a third of their uranium demand in country, with one exception. If uranium gets expensive enough, they can potentially get uranium out of phosphate tails. They have the largest amount of phosphate tails in China. Thus far, we've seen zero evidence that is happening, and we know that it needs much, much higher prices to incentivize that. So even when prices were high, following the previous bull market, they were still pouring billions of dollars into developing Husab in Namibia, which is low-grade sand, essentially. And it cost them way more than they were expecting, took longer. But now it's up and running. It's producing decently well. They're getting 12, 13 million pounds a year out of Husab. So their domestic production is never going, well, I won't say never because of the phosphate tails thing. At $200 a pound, we're probably going to start to see uranium coming from phosphate tails, probably. Mm-hmm. How much and how quickly, I don't know. But that is out there. Until and unless that happens, they're not going to get it out of mining out of the ground. So maybe they'll get 5 million pounds a year or something like that out of China. They have been signing more contracts. Famously, recently, they signed a contract that was large enough with Kazatomprom that Kazatomprom had to have a special shareholder meeting to approve the contract because it was at least 50% and up to 200% of the book value of the company. So that was a big contract. We have yet to see the actual details on that contract, prices paid and total volume, but we know it was big enough to trigger that shareholder vote. And then there's the acquisitions part, and they have been relatively quiet on that front. Recently, they've been in Niger. They have been looking at restarting the development of a project that they are in control of. Of course, that project is also large, open pit, kind of low grade, sort of like Orano's Imaurin, but a stone's throw away is Global Atomic's DASA, which is an underground mine, very high grade for Africa, the highest grade, largest deposit in Africa. So will they go after that? I don't know. Certainly possible. They have obviously a large presence in Namibia. Will they increase their percentage? They own 25% of Paladin's Langer Heinrich. Will they increase their percentage there? I don't know. That's a possibility. Will they develop another big open pit mine, whether that's something that's already had a feasibility study done from one of the developing companies there, like Deep Yellow or Bannerman or Forcis, any of those guys? That's possible. Not really sure. But Africa is where we assume they probably will go after. They can't own, I think it's more than 20% of any project in Canada. So most likely they're going to go after some development stuff in Africa. That's my guess, because A, they don't seem to be slowing down on their build out plans. In fact, they seem to be hitting the mark. Mm-hmm. And B, they just don't have domestic production sufficient for their needs. So more than likely, rather than, and then C, looking at the contract availability from the current producing companies, it's like, well, maybe they'll sign contracts with Orano from 2035 to 2040 or something like that. That's entirely possible. Maybe they'll soak up as much as they can. But as far as current producers that have the ability to ramp up production, we're only looking literally at Kazakhstan and Uzbekistan primarily. The Uzbeks produce about 8 or 9 million pounds a year.
How much capacity do those guys have to increase at this point?
Well, according to Navoy, which is the uranium mining company in state-owned mining company in Uzbekistan, they're looking to hopefully double production by 2030. So let's say another 7, 8, 9 million pounds per year by 2030. So incrementally, another extra million pounds for the next few years, essentially, is what we're looking at.
And how about from Kazakhstan?
Kazakhstan, according to them, I mean, if you actually look at projected potential production as they've stated in their investor decks over the past few years, they claim that they can hit 75 to 80 million pounds a year. That is going to take an enormous amount of development and capital. It also can't happen quickly. It can't happen nearly as quickly as the investors that are concerned about it think that it can. So, they think that Kazakhstan is just kind of like the unregulated Far East and they get away with anything. That's not the case. They have their own bureaucratic channels that they have to go through. New deposits, the new joint venture deposit between Orano and Kazatomprom. This is a big mine. They're aggressively getting this into development. The first pounds for that are at least 3 years out and probably more like 4 to 5 years out. So we do expect them to increase production. It's not going to happen this year. Will probably be incremental next year, but let's say 2025 will probably get a few million pounds more. 2026, depending on how much they invest in the next 18 months into wellfield development, that's really going to dictate how much they'll be able to produce and increasingly do so. But all of those pounds, I mean, even if we get an additional, like let's say they ramp all out and 3 years from now, they're producing 70 million pounds instead of 60 million pounds. That's an extra 10 million pounds. I mean, that's a fart in the wind when we're looking at the demand picture here. It really is. This is not something to fear. This is something to pull for because we don't want the industry to break. We want the industry to be able to function. We're going to have more production for that to happen.
Yeah. And of course, that higher sustained price to be able to bring those other projects into production safely, which I think is totally warranted considering how long this, this previous cycle was, where there was overproduction, and there were so many people that are just, I think, tired of being kind of kneecapped all the time when you see, or when they're used to dealing with the opacity of this market. Now it seems like things are becoming a little bit clearer. This shortfall in production really seems to be pronounced now, right?
It is. Yeah, that's a really good point, Tom. Things do seem to be much more clear than usual. That is absolutely true. And what's really come around over the past, especially 6 months, but even the past couple of months with this latest move, are the price reporters. With in particular UXC, which historically has been relatively conservative. I mean, they've had the investing side could see right through the incredibly tepid and almost seemingly ignorant price expectations that they've been putting out for years. Could see through that for a very long time, but finally they're like, "Hey guys, we've got a problem here. We've got 200 million pounds of uncovered demand for the next 5 years, and the two largest producers don't have anything to sell. So what gives?" And this seemingly just kind of snuck up on them. And of course, importantly, their messaging is not to me or to you or to the retail audience on Twitter. Their messaging is to nuclear utilities. That's their primary clientele. And so when they're starting to tell their clientele, basically expect prices to keep moving higher, that's a big signal to the industry, because that's not typically what they say. Typically what they say is, here's what we're seeing. And to be fair, it's not their job to have a crystal ball. But the investing side, because the inherent in investing and in markets, you're trying to discount the future, right? So you're trying to predict what's going to happen so that you can make money on that prediction. That's the core of investing. Well, that's not the case with utilities. They don't have an incentive to predict the future. A fuel buyer, basically, he's got a budget that's dictated by somebody that's not him or her, and he's got fuel he needs to buy to fuel that reactor, period. He doesn't need to say, okay, I think prices are going to be higher in 6 months, so we should buy now, boss. And the boss says, what did UXC print last week? Okay, let's check that out. And we'll go from there. So it really wasn't their job to put their neck on the line and guess that now is a better price to buy than in the future. And especially, one last point to this is like, this situation in Ukraine is a completely exogenous event. This is something that the industry didn't expect, and it's changed things a lot. And so a lot of utilities, the first 6 to 12 months following that, the initial invasion, were just kind of like, okay, well, this kind of messed up. We don't really want to, call up our buddies at Uranium One right now because of the situation, but maybe things settle down and we go back to business as usual, right? That was sort of a hope for a lot of utilities last year. And I think the reality that's sort of coming to them now is like, well, not only do we not know when this conflict is going to end, but when it does, we still might not have a friendly situation between the West and Russia. So and the utilities don't like risk. They don't like supply risk. So if you secure a contract with a Russian uranium producer, and you think that 2 years from now there could be further conflicts than the situation is right now, that's a supply risk. And utilities don't like to take that supply risk, despite what they may or may not feel about the situation or where the political rhetoric is at the moment. It doesn't really matter. If they think there's a chance they might not get those pounds, they're less likely to contract with that entity. So all of these things are sort of culminating in an extremely thin market. A recognition by the utilities that this bifurcated market is probably going to stick at least for the time period that we need to cover. And just, producers essentially being sold out because of that quickening of the demand based on the carry trade unwind and based on utilities flexing up. It's all of these things have coalesced to create an extremely, extremely near to midterm supply situation where small demand is equaling big price moves. And nobody knows if or what will come in to short-term fix this situation on the supply side.
Well, that was actually something that I did want to ask you about is how the Russian sanctions have really affected the rest of the market. And the other part of that I want to dig into, Justin, is how reliant does the West remain on Russian uranium?
In the near term, still pretty reliant. So that's one thing that hasn't been as disrupted as the rest of the fuel cycle, let's say, is the actual deliveries to the West, to the United States, to Canada primarily, and to the EU as well, of legacy contracts for enrichment and EUP coming from Russia. So short term, still pretty reliant, which is why there haven't been official sanctions on Russian material coming from the US or from Canada, right? There's been issues with shipping. There's been, obviously just kind of the voluntary avoidance of new contracts with Russia, but actual reliance on the continuing delivery of Russian uranium is quite high in the United States in the short term. But as new contracts for enrichment that have been signed over the previous years with non-Russian entities, and there already has been the Russian suspension agreement, which limits the amount of Russian material that US utilities can buy to, about 25% of their needs they can buy from Russia. So it's already not like 100% reliant, but there's a few utilities that if they could not receive those deliveries in the next 6 to 12 months, they'd be in trouble.
So all that being considered, Justin, has the US been, let's say, fully aligned to move forward in securing more domestic supply?
It's trying to get there. They've put the most focus on enrichment, and that has primarily come from Department of Energy contracts with Centrus and potentially other enrichers to ramp up production, especially for whatever reason they seem to be more concerned about developing HALEU circuits to produce high assay, low enriched uranium for future SMR demand. Mm-hmm. The main reason to get that started is because there are 2 development projects that are being partially funded by the DOE for first of a kind SMRs. That's X Energy's XE100 is being built in the state of Washington, and Natrium, the TerraPower Natrium reactor, which is being built in Wyoming. And so those two, both of those designs run on HALEU, and the only source of HALEU right now is Russia. So the DOE technically could downblend material for that first core load. In fact, they probably will, but they're trying to get HALEU circuits developed in the United States because it seems to us that the Department of Energy, the future of nuclear in the United States is looking like SMRs is going to be the way. And the main reason I think, honestly, for that is because the incredible cost overruns at the more recent builds, especially the Vogtle plant in Georgia, just huge cost overruns that bankrupted Westinghouse, essentially. That project bankrupted Westinghouse. It was a big problem, let's say, in that incredible cost overrun. And there was a lot of lessons learned from that. But the DOE seems to be looking at small modular reactors. They're really excited about the potential for SMRs to replace coal power plants. And the DOE is pushing for all of that. So if we get the NRC, the Nuclear Regulatory Commission, on board with this, and the NRC develops a framework for regulating and approving and permitting new advanced reactor designs, then we probably are going to see new SMR builds in the States. So they're working on getting that enrichment going. There hasn't been a whole lot of support for actual uranium mining. That's been mostly price dictated, and price is starting to move in the direction that's going to be able to be profitable for ISR miners in the United States. So Encore Energy is moving really quickly towards producing. UEC is starting to talk about it. Peninsula was working on it before they had a rug pull from UEC with their processing facility. Cameco's got some assets in the US, but they haven't talked about developing those yet. Either way, we're moving in the right direction, but as is typical, bureaucracies can take a very, very long time.
Mm-hmm. Yeah, and then there was an announcement of, really outlining and saying that there is not going to be any uranium mining around, I believe, the Grand Canyon, even though there are some very interesting deposits there, right?
Yeah, really interesting. There's very unique geology around the Grand Canyon. And so this area is known as the Arizona Strip, northern Arizona. There's a lot of deposits that are called breccia pipes. And I'm not a geologist, so I'm not going to be able to describe this very well, but it's essentially just like a vertical pipe of unique high grade ore typically. And there's a lot of different metals held in these breccia pipes, and some of them have uranium and some of them have basically kind of the highest grades of uranium you're going to find in the United States. There's only a few companies that own most of these, the state that's staking the most of these projects, but the United States Geological Survey did a survey back in the 1990s and estimated that there was more than 1 billion pounds of uranium in the Arizona Strip alone. So a lot of times you'll hear people say, yeah, there's not a lot of uranium in the United States. It's absolutely not true. There's a hell of a lot of uranium here. Will it ever be mined around the Grand Canyon and in the Arizona Strip? That's not something we can really expect, probably. No. Energy Fuels has an active mine that's south of the Grand Canyon. There's historical mines to the north of Grand Canyon. It's kind of a shame. It really is, because these types of mines, these underground mines in this very, very narrow vertical kind of ore body, are very low impact, very low risk. In fact, you can actually go to where there was a historical mine in one of these breccia pipes at the northern part of the Grand Canyon, on the mesa to the north of the canyon. You cannot find where the mine was. You can't find it. If you're standing right on top of it, you would never have known that there was a mine there. So it's unfortunate, because it would go a long way towards securing more domestic supply and therefore de-risking the nuclear fleet in the United States. But politics is what politics is, and it's not always going to go in line with what maybe makes most sense for national security.
And do you know how close these mines actually would be to the Grand Canyon? Would it be something that you would see that would be an eyesore that would affect tourism or anything in any way? Or is it, for anybody that's ever been to that area, there's a lot of land around there that seems to be, basically, almost useless and unused, period. Right.
Yeah, I think the biggest concern really is the contamination of the Colorado River, right? Mm-hmm. Of processing material. Obviously, this is an underground mine. It wouldn't necessarily be an ISR mine. It wouldn't be like a heap leach. There wouldn't necessarily have to be processing at the site. You could literally truck the ore to White Mesa. But they're relatively low impact sites. And how far are they? Some of them are relatively close, within a mile or two. Some of them are 50 miles from the Grand Canyon and more. Mm-hmm. Most of these breccia pipe deposits are on the northern part of the canyon. All of the tourism for the canyon is on the southern rim of the canyon. So I don't think it would really affect things on that front. But, there's also sensitive First Nations relations that are there. And they're, to be fair, historically speaking, the uranium mining industry has not been very responsible towards local communities, especially in Arizona, New Mexico in the 1980s. They left a big mess. A lot of the miners got sick. They have a lot of mess to clean up there. So I understand why the sentiment is the way it is in the southern United States towards the uranium industry. Could that be different going forward? And are there companies that are working on those relationships? Yes. But nobody's holding their breath for the breccia pipes to be mined.
Okay. Yeah, I mean, that's totally fair, especially if you consider the history there.
Yeah.
Justin, another subject I wanted to kind of touch on you with is, let's say, to try to understand if the structure of the actual term market and spot market are changing. Are there more, let's say, utilities or entities coming into the spot market versus, trying to end up buying out on the term market? Has the structure of how pounds are acquired, has it changed over, let's say, the time that you have been watching this so closely?
It's changed a lot. Yeah, it's changed a lot. So when I first started following this market, which was late 2016 and then into 2017, you still had a lot of above ground mobile inventory. You had utilities primarily securing their forward needs through either spot market purchases or midterm contracts, primarily being signed with traders, with carry traders. And the reasoning for that is you could sign a contract with the trader at prices that were not much higher than the spot market itself, and not have to actually go to producers that needed much higher prices, right? Outside of Kazatomprom. So Kazatomprom still at that time were producing a lot of material. They were still making money primarily because of a currency arbitrage, right? They had a rapidly depreciating Kazakh tenge, and they were selling in US dollars. And that sort of started to end as they eventually went public in 2018, or partially public, I should say. But the utilities did a lot of inventory bolstering via the spot market because there was just abundant supply and it was relatively cheap. And either that or short to midterm contracts with carry traders. They wouldn't necessarily want to buy 5 to 10 years out with a producer that was asking for prices higher than the current spot and term price. Because there was so much abundance, there was no need, there was no security of supply concerns. There was no need to pay what needed to be paid above market prices with a producer to secure. Like very few contracts were signed like that during that period of time. And since then, of course, long story between then and now, but basically now utilities are largely avoiding the spot market because there's nothing there. There's just not enough material there. And they know that buying in the spot market moves the spot price. So if you're a utility that has market referenced contract deliveries due now and next year and the year after, which they all do, to the extent that your action in the spot market is going to be moving prices up, you're probably going to avoid that because you're going to have to pay twice. You're going to pay for those pounds right now, and you're going to pay on the increased market price at the time of your delivery in that legacy contract. So utilities are pretty quickly going to the term market for their uncovered needs. Luckily in this industry, utilities stay mostly covered for the near term. So the US is typically covered about 2 years, maybe a little bit more. The EU about 3 years, a little bit more. The Japanese usually far more covered. The Chinese far more covered. But there are some uncovered utilities that have RFPs out in the market for first deliveries next year. So they're coming back into the term market. There's a lot of tenders in the market right now. Like I said, we expect that a lot of these tenders will get inked in the next month or two, and that'll add to that total long-term contracting number for the year, which right now is 120 million pounds have been signed officially, which that probably grabs about 85% of the market. So it's probably a bit more, but yeah, it's going to be term market. It's going to be term market and nothing else. The only other way that utilities are going to hopefully secure pounds is through contracts with developers and potentially offtake agreements with developers. So any uranium mining companies that are in development now or considering developing in the next couple of years, they are all hearing from utilities. They're all hearing from utilities right now. And some of them might not have huge production profiles and are holding out. So for example, Boss that has the Honeymoon project, it's a ISR brownfield restart. It was formerly owned by Uranium One. They had a lot of problems with the deposit when they were operating it, which is probably why they sold it. But the Boss team has been doing a great job getting that close to production. But they are multiple years ramping up to maybe 2 to 2.5 million pounds a year. Not a lot coming from that. So for them, they don't really need to de-risk by signing these early contracts. They're just not signing anything. That they can just sell, couple 100,000 pounds a month. They're going to be producing whatever it is in the spot market, whatever the market price is, which is probably going to be far higher than it is now 2-3 years from now. So only developers that have larger production profiles and financial needs in order to de-risk the capital investment that's going to take are looking at signing some contracts and offtakes right now.
So kind of stepping back another layer here, Justin, how do you see, let's say, the threat of recession or a broader market sell-off affecting, everything that's going on right now? It seems like everything is really turning in a positive direction for uranium, the developers, the miners, all of these guys. But if we get a real risk-off event in the broader equities, are you worried that will affect the uranium sector as well?
I mean, it really depends on, I think, the veracity of the sell-off. So if the broad market just kind of turns down and starts to move down, selling off 0.5% a day or something like that, and the spot market's moving, we very well could see a continuation of a kind of a rotation of money. I mean, just even today, we're seeing huge volumes in the sector right now, just huge, absolute breakout bull market type volumes in the securities. Of course, this is not a big risk off day, but I mean, if we see Black Monday part 2, yeah, it's going to take everything down. And that's entirely possible. But what I've been saying over the past month to 6 weeks or so is what I really, really hope to happen is to have a broad market influenced correction here, because my confidence in where this is going is so high that I would love to buy more at prices that are lower here, despite the fact that I have been a consistent dip buyer for years. I hold for the long term and I buy when it's weak. When my confidence is high in this market, it's been confident for a while. Right now, it's very, very confident in where the spot price is going, which is higher. So would I love to load the boat and buy a bunch of deeply out of the money call spreads if we see a 10, 15, 20% correction? 100%. So fingers crossed for that. So no, I'm not worried, but will uranium equities get hit if we see steep declines in the S&P or the Qs or the Dow or whatever? Yeah, for sure. Definitely. I mean, they have historically, so I don't see why that would be different this time. If we have a liquidity event, basically, if you're worried, you sell what you own. So if you own a bunch of uranium stocks, that's what you're selling. So yeah, it certainly could happen. Full disclosure, I'm short the market and super long uranium equity. So I don't really trade in and out of these things based on my fears around what the Qs are going to do. I'll just short the Qs, and if they tank, I'll cash out that short and I'll add more to my longs. But that's just me. So yes.
Yeah, I liked what you said before we hit record here today, is that, even though this is a really exciting time in the uranium industry, this is actually very boring for you because you established these positions a long time ago, and you're not going to keep chasing something, which I think is just the absolute right way to go about actually trading and establishing positions.
Right. Exactly. Yeah. I mean, today, right now, URNM just absolutely up on stilts. That's the Sprott Uranium Miners ETF. It's up over 5% with breakout volume today. It's like, there's nothing for me to do here. I mean, I'm not a swing trader. If I was a swing trader, I might actually be taking a little bit of profit and putting some cash in my pocket right now. And that's not a bad idea. But this is all flows. It's all flows. You're looking at valuations. You're trying to make sense of some of the valuations. Some of these things are so freaking overvalued. Some stocks are really overvalued. There's still some that are very undervalued here. But even then, I don't like to buy when the RSI is at 80, 85. I just don't. I can't. Psychologically, I can't chase. It's just, maybe that's a problem. I've always had a hard time buying all-time highs. Yet I know one of my friends who's an incredibly skilled technical trader. Some of the best trades of his life are buying all-time highs. But it is what it is, right? I just don't like to trade like that. I don't like to swing trade. I don't like to give the tax man more money. I'm in the United States. I'm in California, let alone the United States. So short-term capital gains really hurt. So I don't want to reset that capital gains clock by skimming profits when I know the price is going higher for uranium. With all of that said, the sector is overbought here. Will it take a breather? Will it pull back a bit? Probably. But those dips, I don't expect the dips to be very long if the price of uranium keeps moving. So if we see $70 break mid-market, which I think we're actually going to see today, if we see the previous resistance, which is pre-Fukushima, and I think that was like 73 something per pound, we see that broken through, this could just get totally wacky to the upside. So I don't like missing the boat. I don't like taking money off the table when I can see a clear upside case for the commodity itself. But if you're a trader, you're probably trying to trade in and out of these things, and this is probably one of those days to think about peeling back a little bit.
Justin, obviously, Sprott's physical uranium trust SPUT was a major development in this space. So have there been any changes and, let's say, developments that are waiting to be approved with the physical fund here?
Yeah, there's been some changes. So their last large ATM allowance, which was north of $1 billion, if I recall correctly, That expired a couple of weeks back. They had to re-up that ATM, which they did with the Ontario Securities Commission, with a much, much smaller ATM, $250 million, of which they only have access to 125. Once they have that thoroughly raised, then they can come back and get permission for the additional 125. So something's a little bit different going on there. The other thing is that they announced to the market on the day of the WNA symposium, which is kind of interesting and I thought was smart, that they intend to apply to the OSC for a physical redemption mechanism for this vehicle. And there's not a lot that we know for sure about this potential redemption mechanism, but we do understand thus far is that it will only be allowed likely for industry players, so utilities, potentially traders, to take physical delivery. It will have minimums and maximums in terms of volume. So, for example, if you happen to own an enormous amount of trust units, you're probably not going to be able to redeem for 5 million pounds of uranium, right? There's also going to be limitations on frequency. So, utilities or traders only, minimum and maximum volumes. And to our understanding, this can only happen once every 12 months. So this is something that I think it's brilliant. And I really do hope that they go for it and that it is approved. Why is it brilliant? Because if you buy trust units at a discount and you are a utility or a trader, an industry player that can take physical delivery, if you buy, let's say, at a 5% discount and you redeem for physical, you redeem for physical at NAV. So you literally did buy pounds at a discount. Utilities would like that option, okay? The other thing is that is going to keep the trust very close to NAV, basically all the time, which makes it perversely far easier for them to raise and get up to a premium. So if you're a utility, you want to buy trust units, if that purchase pushes them to a premium, they're actually a competitor in the market with you. Mm-hmm. So it's kind of this catch-22. While at the same time, it also satisfies the utility's potential concern that this financial entity is sitting on 60-something million pounds of uranium, but we can't have access to that and we don't have anything to buy in the market. So what gives, right? Now they do. Now they can't complain about that. And it's brilliant because now they're not going to come after them or have, some sort of federal agency come after them and force them somehow to sell those pounds. It's also not spot market selling availability. So it's not Sprott selling the pounds. It's Sprott redeeming a trust unit owner for physical that can only go to an industry player, AKA probably an end user. So utility that needs that uranium, they're not going to flip it and just dump it into spot, which has been one of the concerns of, retail investors in this space is like, okay, well, Sprott sitting on whatever it is, 65 million pounds. I can't remember the exact number. What happens when they start selling? Well, they're not, and they can't. And I think it would take a shareholder vote anyways to approve Sprott to actually be spot market sellers. And the shareholders of that vehicle will never want that to happen. So this satisfies so many different elements. I think it's brilliant. I really hope it happens. But either way, as far as I'm concerned, the Sprott Physical Uranium Trust already did the heavy lifting. They cleaned out the spot market and they cleaned out like 20, 25 million pounds held by carry traders. And there's just not a lot of material there anyway. So I don't really care that the ATM is smaller. I don't care that now they're only raising 5 or 10 million a day instead of 50 to 100. I don't care because the material is not there. And they also have a couple things to consider, which I think is really interesting, that the CEO, John Chapaglia, made clear in our last conversation with him, which was, I had asked him, so there were 2 days in a row about 2 weeks ago where the first day they raised $16 million. The following day, they had greater trading volume, were clearly at a premium to NAV the whole day, and they raised half of that. They raised $8 million. I said, so what was the deal with that? The market was kind of rubbing their heads like, okay, you guys had a much higher volume day. You were obviously at a premium. Why'd you raise less than the day before? He's like, well, we saw the ask jump up $2.50. And if we chased that and raised enough cash to chase that and buy that, it would immediately put us back at a discount because it would realize that ask and that would bump up the price, the official reported price in the spot market. So that's what he was calling INAV, or indicative net asset value. So they have to not only think about, if we purchase these pounds at this higher price, what does that do to our valuation relative to NAV? but they also have to have line of sight on pounds. So before they even raise the cash, they want to know what's in the market at what price. Mm-hmm. So even if they're flying, I mean, today I'm sure they're at a premium and the volumes are big. If they don't see sufficient pounds in the market at X price for X many dollars, they're not going to raise that cash. Mm-hmm. So the sign that if you see big days like today and they say, oh, we raised three or $4 million and we didn't buy in uranium, like, well, that's why. Mm-hmm. And the market is so thin that they don't want to be the buyer on the margin. They don't want to just be slamming it higher. They want to have line of sight on pounds, and they want to pay attention to INAV as well. And I think that's really interesting.
From that perspective, it makes them look like a responsible market player.
It does, yeah. And I honestly think, their role has gone from being a vehicle where market speculators can squeeze the physical market and for them to buy hand over fist and shake up the industry. That's what happened, those two big runs. Now I think they're basically going to be a floor. Mm-hmm. I think they're just going to be a floor in the spot market. 100,000 pounds here, 100,000 pounds there. And that's a floor. That's a floor now. 100,000 pounds it can create a floor in the market. It's wild. It's crazy.
Justin, one of the last topics I wanted to touch on with you is something that you mentioned earlier, and that's, let's say, the demand from the SMR side of the market, and the fact that that is not really, being counted in this market. Is it because of the type of fuel that is needed for the SMRs? Is it because of regulations? Why is that a piece that doesn't have much clarity around it, let's say?
Well, I think for the most part, it's still a hopeful situation, right? I mean, yes, there's dozens and dozens. I think there's more than 80 different SMR designs that are being worked on, engineered and developed right now. And not developed and built, but on paper, in the works, being created. But actual under construction, there's very few. The Chinese are working on the very first one. There's the BWRX, GE Hitachi's BWRX 300. There's 4 of those being built at the Darlington facility in Ontario. Then there's hundreds and hundreds that are in various stages of planning and proposal around the world in dozens of countries. But for an investor to model out demand around this, it's just still too speculative, because we can't yet really hang our hats on that demand. But like I mentioned earlier, there already is an RFP in the market for delivery starting in 2024 for uranium contained in enrichment for SMRs. And we think that's OPG for the Darlington project. Not sure. They don't tell us that level of detail, but we think that's where it's coming from. It doesn't really matter. The fact that an SMR that's expected to be producing electricity in the early 2030s, that the builders of that SMR are buying uranium for that project right now, in my opinion, is huge. It's absolutely huge. But it's still just too speculative. Until we actually see more construction starts for small modular reactors and more tenders in the market for that material, then we can start to say, okay, it's likely that this project is going to see a construction start on this date, and the demand we can expect sometime around this time. Then you can start to actually model it out. But most of the time, ourselves, as well as our industry contacts on the finance side of things, are conservative with supply and demand modeling. So, you don't price in that every single reactor is going to get a life extension when it comes up. You don't price in all the small modular reactor possible projects, et cetera, et cetera. You're conservative with these things, so you don't get surprised by some change in the market to the downside. With all of that said, TradeTech, who arguably has been far more accurate than their competitor in terms of analyzing the nuclear fuels market and reporting on price, TradeTech is estimating that we could see as much as 200 million pounds of uranium demand by 2035 for SMRs alone. And I actually think that could be on the conservative side. It really just depends on how fast the snowballs. I don't really know how fast it's going to be embraced, but it could be an incredible revolution for nuclear. It could be something that's just kind of a little bit of demand here and there. Don't really know. But, modeling out for zero SMR demand, we still have a very, very large deficit going out to the end of this decade. And we've got this, I keep calling it the supply black hole for the next 4 to 5 years. And that's the thing with mining in general, but especially with uranium mining. You just can't address shortfalls quickly. You can't bring supply on quickly. You just can't do it. It takes a lot of time. It's a highly regulated commodity. It's some jurisdictions, it's very controversial and difficult to get things developed. Even in very safe jurisdictions, I mean, look at what Cameco announced a few weeks ago. Just before WNA, they announced that both McArthur River and Cigar Lake are not going to hit their production targets for 2023. And Cameco, and they cited a couple of supply chain problems. They cited a difficulty with labor. I mean, if they can't attract the labor and can't get the supply chains right in Canada, what's going to happen in Namibia and Niger? Mm-hmm. It's just, you can't bring that supply on fast enough. So that's one of those things that, despite the fact that the market can be very opaque, there's a lot of these supply and demand numbers spinning around. What you can see is a deficit for the next 5 years, and you can very, very easily model out what supply is going to come online during that time period. I'm going to tell you right now, it's nowhere near sufficient to satisfy the demands that are going to be in the market. So we're very confident in the price going a lot higher.
Mm-hmm. Well, Justin, there's a lot of exciting stuff going on in the uranium market, and I really appreciate you coming back on to keep us updated on it. Is there anything else you think that there's worth mentioning before we wrap up?
I don't think so. I mean, the thing that I've been mainly trying to hammer home is, when the sector gets hot like this, it brings a lot of new attention to the sector, and it can just never be any other way, right? That's just how it is. Nobody wants it at the time you really should be buying, and everybody wants it at the time where maybe it's getting overbought, possibly should be trimming. I'm not a seller here because I think the price is going far higher, and I think this could have legs if we break up and out through that $73, $75 range, and I think that we will. But the main thing that has kept us at this table and allowed us to have the conviction to buy when it was out of favor is an understanding of the physical market. And that's the most important thing that we focus on. And if you're watching this right now and you're new to the sector, spend some time educating yourself about the fuel cycle and educating yourself about the physical market, because capital markets are far less predictable, far more volatile. And the physical market, once you have a grasp of what's going on here, you can have an incredible amount of conviction for the trade. And that either helps you to hang on during the volatility, which shakes a lot of people out. I mean, there is a trail of bodies from the last 18 months, miles long. Or even better, have the conviction to put money to work when everybody is bearish, just because the price on the screen becomes the narrative, and you don't want to follow that narrative. Or you can just trade the technicals, buy it when it crosses above the rising 200-day and sell it when it crosses below the falling 200-day. Just do that and ignore everything I just said for the last hour. But either way, this is a fundamental trade for me. It's not a technical trade. So I'm looking at the charts. I'm like, man, these are overbought temporarily here. But knowing what's happening in the physical market is so valuable. And that's really what we've tried to wrap our heads around more than anything. And express that to the members that support us in the work that we're doing. And that has helped all of those people to stay in this trade through a difficult correction that we just went through, and to put money to work at the right times over this past year. And hopefully they did, and are really, really sitting pretty right now. So pay attention to the physical market, learn about the fuel cycle. Don't just follow a bunch of proclamations from Uranium XYZ on Twitter. Make sure you do some of your own work, or at least follow people that are discussing the physical market and the fuel cycle, because that's where you have to spend your time to really grasp what's going on in this supply demand situation for uranium.
Yeah, and of course, you're an excellent resource to learn a good amount from at Uranium Insider on Twitter and uraniuminsider.com, right?
Yep. This is all we do. So that's really our goal, is to take all of this information and try to distill it down so that the material that we put out can contain more concise conclusions to the incredibly vast and convoluted data that is out there. it can be quite overwhelming, but basically it doesn't have to be that difficult. We're in a bull market for the commodity. So for the most part, you want to sit on core positions and just ride it out. But if you understand what's happening and you've got some risk tolerance and you can put money to work as a contrarian when it's out of favor, that has worked extremely well for us in the past. So I'm going to keep doing that until it doesn't work anymore.
Perfect. Justin, thanks so much for your time today.
Always a pleasure. Thanks, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.